Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Energy Transfer stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 55 billion market cap. They're trading at $16 a share, and they have 3.4 billion shares outstanding. Energy Transfer is engaged in the pipeline transportation, storage, and terminaling for natural gas, crude oil, natural gas liquids, refined products, and liquid natural gas. It owns and operates more than 125,000 miles of pipelines throughout the U.S., making it one of the largest midstream companies in the country. It is also one of the largest exporters of NGLs, natural gas liquids. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow in 2020, $2.2 billion, up 270% to $8.3 billion. In 2022, went down 32% to $5.7 billion, but up 13% in 2023 to $6.4 billion. When I started preparing for this video, they did not release their first quarter earnings, but they did release it just the other day. So all these numbers are through 2023, but we'll look at their first quarter results a little later. They pay a big dividend, 8%, which means they pay $4.3 billion in dividend payments, so they can easily afford that dividend. Net income is a profit or loss on the income statement. It's revenue minus expenses. Almost flat in 2020, $7 billion in 2021. Then it went down the next 2 years, $5.9 billion to $5.3 billion. But they have plenty of cash flow to afford the dividend payment. I dropped $50K into the stock in January 2022. My cost basis was $864. So I'm up over 100% if you include the dividend payments. Revenue is a sales for the company, and they generate more revenue than any other midstream company. $90 billion in 2022, a little under $80 billion in 2023. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year for that $73 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $70 billion. We divide that by 3.4 billion shares. And we get a calculated stock price of $21. They're trading at $16, so they're trading at a 22% discount. It's a buy according to the model. There are 48 companies in the same industry as ET, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, $3.1 billion. TC Energy spends the most at $5.7 billion. Debt to equity is a bit high. Most companies have a high debt to equity ratio in this industry. They are higher than the median, lower than the average. They pay one of the bigger dividends, nearly 8%. Midstream companies tend to pay high dividends, but a lot of these are MLPs, so you pay the higher tax rate. Free cash flow is nearly the highest. Enbridge is number 1 at $7 billion. Their market cap is third. The only companies bigger are Enbridge and Enterprise. They have really attractive price multiples, 10 times earnings, 8.5 times free cash flow. That means their market cap is 8.5 times their free cash flow. They generate more revenue than anybody else by far. They almost generate the same amount of revenue as the top 2 companies combined. They're still growing. Their 5-year annual revenue growth rate is 8%. Look at Antero, 81%. Timing is much more important when investing in a commodity-linked stock than a regular stock like an Apple. If you put $10,000 into this company 10 years ago and reinvested the dividends back into them, you'd be down 30% to $7,000. But let's say 4 years ago you put $10,000 into this company, you'd be up like 200%. I'm fortunate, I'm up over 100% because I put it back here. But you never know where oil prices will go in the future. In the past 5 years, this stock is only up 7%. The red line, which jumps out over here, that's the price of Brent crude, up about 17% in the past 5 years. And these other lines are other midstream companies. You can see they all move together. The worst is Kinder Morgan, down 5%. The best is Williams, up 41%. MPLX is up 32%. Let's go through their first quarter earnings. It was released on May 8th. Net income of $1.25 billion, EPS of 32 cents. It's actually not EPS, it's EPU, earnings per unit, because they don't have shares, they have units. They're an MLP. Adjusted EBITDA, $3.9 billion. That's up from $3.4 billion in the first quarter of 2023. Distributable cash flow, $2.4 billion, up from $2 billion. They give breakdowns of EBITDA and DCF, in case you were curious what those mean. They have a new record for crude oil transportation, up 44% in this quarter. Terminal volumes, up 10%. Terminal volumes means how much product is stored at their terminals. And they store different products, not just traditional crude oil. They also store NGL, LNG. NGL fractionation up 11%. It's the process of boiling off different hydrocarbons one by one, because each hydrocarbon has a different boiling point as temperature increases. Natural gas liquid exports up 6%, transportation volumes up 5%, that's transportation through their pipelines. Interstate gas transportation volumes up 5%, midstream up only 1%. And they completed their trunkline pipeline backhaul project. Trunkline pipeline is a natural gas pipeline system. It brings gas from the Gulf Coast of Texas and Louisiana through Mississippi, Arkansas, Tennessee, and Kentucky, eventually delivering the gas to Illinois and Indiana. It connects to the Henry Hub, Egan Hub, and Perryville Hub. They adjusted up their EBITDA for 2024. It was $14.5 to $14.8 billion. It went up to $15 to $15.3 billion. There are two things that really affect the stock: the earnings and their future earnings. So a company can have really poor earnings for a quarter, but the stock goes up a lot, because if their forecast for the rest of the year or the following quarter is really high, then people will buy the stock. I'll give you an extreme example. Say they totally whiffed on earnings for the first quarter, but they said adjusted EBITDA would be $20 billion, up from $14.5 billion. The stock would go to the moon. On the flip side, if they crushed earnings for the first quarter, but they said adjusted EBITDA is going to go down from $14.5 billion to $10 billion, because people say that all the time. They beat earnings, why is the stock going down? Or they missed earnings, why is the stock going up? Well, it's usually because of the forecast of the future. There's another reason the stock may go up with poor earnings and down with great earnings. But I don't want to bore you, so let's just move on. And they expect their 2024 CapEx spend to be $2.9 billion. Their senior unsecured debt was upgraded to BBB. The higher their debt rating, the lower the interest they have to pay on the debt. BBB is investment grade. Anything below BBB, like BB, single B, that's below investment grade. The best is AAA, then AA, single A, BBB, double B, single B. Their first quarter dividend was a little less than 32 cents. $1.27 annualized. They have over 125,000 miles of pipeline across 44 states. They're the parent of Sunoco, ticker SUN. So you can invest just in the gas stations if you go to this ticker. They have 10,000 convenience stores, all in the US. They also have 9,500 miles of pipeline and over 100 terminals. But most of their pipeline is with ET, not Sunoco. Another ticker you can invest in that they own is USAC, USA Compression Partners. It's one of the nation's largest independent providers of natural gas compression services. Compression involves increasing the pressure of natural gas, so it's able to be moved through pipelines. So it's a pretty important part of the operation. Here's their income statement. Revenue was $19 billion last year, almost $22 billion this year. Cost of revenue, $17 billion. That's the cost to buy the underlying commodity. Operating expenses, $1.1 billion. That may include payroll, depreciation, depletion, and amortization, $1.3 billion, SG&A, $260 million. That also includes payroll, marketing. So operating income went from $2.1 billion to $2.4 billion. So margins are improving. They're spending more interest on their debt, $728 million. They probably have less debt than last year, less principal amount, but they're paying a higher interest rate. Their equity earnings in unconsolidated affiliates, $98 million. This does not include USAC and SUN. USAC and SUN are consolidated into all their numbers. Unconsolidated affiliates is if they own like less than 20% of a company. If you own other companies, there's different ways to account for that other company's revenue, profits. You may use equity method accounting, cost method accounting, or consolidate their financials. You would know which method to use based on how much you own of that company, the percentage you own. So their net income, $1.7 billion, up from 1.4 billion. They are adding shares, which is not what you want to see. And they've added a lot of shares. It was 3.1 billion last year, now it's 3.4 billion. But they probably added these shares mainly for acquisition purposes, to get more money to acquire others. Let's look at their balance sheet. Current assets 15 billion, current liabilities 13 billion, so they have a good current ratio. Current assets are cash, inventory, accounts receivables, those are the main ones. PP&E, that's the value of their pipelines and terminals and anything else in PP&E, 85 billion, that's a lot. Total assets 116 billion, up from 114 billion. Current liabilities includes things like accounts payables. They have a lot of debt, 52 billion. Maybe that's why the stock seems so undervalued. Assets minus liabilities equals equity. Total equity 44 billion. They raised 5.6 billion from selling preferred units. I'm a common unit holder. They raised 30 billion. And they don't list retained earnings. That's not a thing on an MLP's balance sheet. Here they reconcile net income to adjusted EBITDA and distributable cash flow. Net income 1.7 billion for the quarter. You add back the non-cash items on the income statement, like depreciation, that's a big one, 1.3 billion. You adjust for changes in working capital. Their consolidated adjusted EBITDA 3.9 billion. Their consolidated distributable cash flow 2.9 billion. EBITDA is earnings before interest, taxes, depreciation, amortization. Distributable cash flow includes the interest expense, that's excluded from EBITDA. It includes taxes. That's why DCF is different than EBITDA. Here's a breakdown of their EBITDA, the 3.9 billion. 1 billion is from NGL, natural gas liquids, and refined products, transportation and services. The second biggest is crude oil transportation and services. Invesco, only 240 million. USAC, 139 million. Even though they're a midstream portion, that makes up 700 million of their EBITDA. Let's look at ET on Simply Wall Street. Its last price 16.55 billion market cap, flat in the past week, up a solid 29% in the past year. Let's see what they say about the company. ET provides energy-related services. They own and operate natural gas transportation pipeline and natural gas storage facilities in Texas and Oklahoma, and about 20,000 miles of interstate natural gas pipeline. It also sells natural gas to electric utilities, independent power plants, local distribution, and other marketing companies and industrial end users. In addition, the company owns and operates natural gas gathering pipelines, processing plant, and treating and conditioning facilities in Texas, New Mexico, West Virginia, Pennsylvania, Ohio, Oklahoma, Arkansas, Kansas, Montana, North Dakota, Wyoming, and Louisiana. They also have natural gas gathering, oil pipeline, and oil stabilization facilities in South Texas. They transport and supply water to natural gas producers in Pennsylvania. It owns 5,700 miles of NGL pipeline, NGL fractionation facilities, NGL storage facilities, and other NGL storage assets and terminals. Additionally, the company provides crude oil transportation, terminaling, acquisition, and marketing activities. They own and operate 14,500 miles of crude oil trunk and gathering pipelines, mid-continent and Midwest U.S. They also sell and distribute gasoline, middle distillate, and motor fuels and other petroleum products. It also offers natural gas compression services, carbon dioxide, and hydrogen sulfide removal services. They manage coal and natural resources properties, as well as selling standing timber. They lease coal-related infrastructure facilities. They do everything. They also collect oil and gas royalties and generate electric power. They used to be known as Energy Transfer Equity LP, changed their name to Energy Transfer LP in 2018. They were founded in 1996, headquartered in Dallas, Texas. Here's where they've been trading since 2006. It was about $5.50 a share. Its lowest point ever was in 2008, a little below $4. The stock crashed in 2008, 2015, and 2020. The reason it came down is because the price of Brent crude or the price of oil came down a lot those same time periods. You see it bottomed out in 2008, 2009. Once again in 2015, 2016, it got real low. Even lower in 2020. So if you buy up here, like in 2012, 2013, it's so hard to make a profit. You really have to pick up these stocks when oil is low. Its highest point ever was before the 2015 crash. It was $35.24. So why did oil drop a lot in 2015? Because demand for oil was decreasing. Also, the economies of Europe and other developing countries were weakening. EVs started becoming popular, so vehicles were more fuel efficient, and a devaluation of Chinese currencies. Of course, these are just hiccups. It always recovers. People get scared and the price goes down. These things were all true, but they don't have lasting long-term effects. Like sure, some vehicles are becoming more fuel efficient, but EVs still aren't that big. Only 1% of the cars registered are EVs. That's in the US as of 2023. And the US is a rich country. We like to spend a lot of money. So if we're only 1%, you can imagine how small developing countries are. But like I said, if you time it right, you should make a lot of money. In another 3 years, I'll probably be up 100% just on the dividend payment. So if you got this stock anywhere above 20, it's going to take a long time to make a good return. But if you bought it sub $10 like me, then you'll have a really solid ROI. Simply Wall Street is pretty close to me. They're at $22 a share. They say the stock is 27% undervalued. 17 analysts priced this stock at $19. Their revenue forecast for 2024 is $91 billion, then $87 billion, then $86 billion. That's not a good sign. You want to see it go up, not down. Free cash flow is going up, $6 billion in 24, $6.5 billion in 25, over $7 billion in 26. Their revenue was only $37 billion in 2013. It peaked at $90 billion for 2022. It's come down to $81 billion, but still a lot higher than its competitors. They do have a lot of debt, which is not good, a little concerning, a bit too much. $23 billion in 2013. It's getting pretty high, over $50 billion. And this blue line is their equity, which follows their debt, but it's always below it. Debt to equity ratio of 118%. And this green line is their cash. They have very little, almost no cash on their balance sheet. A lot less than Berkshire Hathaway. Their dividend was 2.7% in 2014. It shot up to over 15% in 2016 because the stock price came down from the oil crash. Its highest ever was 20% in 2020. That's the worst time to buy a stock when the dividend is really high, because usually they cut their dividend to be more in line with the stock price. This says they have a 0% dividend for May 2024, but I don't remember them cutting their dividend. We read earlier it was a little under 32 cents. Same thing on NASDAQ.com. So I think this is just an error on Simply Wall Street. The forecast is 8.8% for 2026. The CEO's salary was $1 million in 2017, up to $1.4 million. Total compensation, $17 million. Tenure as CEO, 3.3 years. In the past year, only insider buying, no selling. Look at all these buys. 1 million, 1 million, 3 million. Kelsey Warren loves this company. Over 8 million shares have been purchased in the past year. 56% of the company is owned by the general public, 34% by institutions, and 10% by insiders. Kelsey donated $1.8 million to Donald Trump's 2020 presidential campaign. Blackstone, one of the biggest private equity firms, they're big on LBOs, leveraged buyouts. The Denver company Alps, they're an asset manager, they own 2%. Invesco 1.7%. Goldman, Morgan Stanley. The New York investment advisor Tortoise owns 1%. John McReynolds has been director of this company for nearly 20 years. Chickasaw, the Tennessee-based asset manager, owns 0.4%. The French bank Natixis, 0.45%. Their employee count has gone down a lot. It was over 30,000 in 2016. Now it's 13,800. And the ticker trades on the New York Stock Exchange and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.